I'm Jared Johnson, and welcome back to the Stock Market Playbook. Today, we're joined by Brad Freeman of the Stock Market Nerd. He has two things he's watching really, really closely that he thinks could be big factors for the 2026 economy, and how to invest in that, and how to approach that, and how to protect yourself, but also still have a good potential to some nice upside. Give it a look on our upcoming episode of the Stock Market Playbook. Welcome back to the Stock Market Podcast. We're happy to have you, and we've got Brad Freeman with us from the Stock Market Nerd. Happy to have you joining us. Thanks for showing up today, Brad.
Happy to be here. Thank you for the invite.
Um, I would say that I'm a little bit of where you are in that, I got a decent amount of hair, and bald guys comment on it, but you're absolutely winning the hair game. I mean, that's that's amazing. I'm jealous. So
This is a byproduct of being very loyal to one hairstylist and her being out of town since mid-November through mid-January. So this is not by design, but we're making it work the best we can.
honestly, it's. I mean, I would keep rolling that way. It's awesome.
Sounds good.
Well, glad to have you with us. So the stock market nerd. This is kind of a research platform, a newsletter. You keep investors updated with what's going on through what's your guys' kind of key focus on your research?
Yeah, I would say sector focus is very much so. There are three: consumer discretionary, consumer internet, and then enterprise software. So split very much so into those three buckets. There are some examples that kind of are involved in other places, but that makes up the lion's share of the coverage network. And it's not growth, it's not value, it's not moonshots or blue chips. It's just finding compelling risk reward and trying to find what I view as a great probability of having a successful investment. So sometimes that looks like a $2 trillion company, sometimes that looks like a $2 billion company, and everything in between. So that those are the themes within the network.
That is great. What's your kind of favorite space in that area right now? We're going into the end of the year. Everyone's kind of, is this Santa Claus rally happening? Is it not happening? It's kind of sporadically happening.
Yeah, I think just generally speaking, within those three areas, I have to be careful not to give specific names too frequently, but within those three areas, I just think risk on is, and I know many people disagree, and that's all part of markets, and we can shake hands and move on, and just again what makes markets. But I do think risk on is pretty compelling heading into 2026. I know the S&P 500 multiple is a little bit stretched. Earnings growth looks pretty solid for next year. Estimates look pretty solid, but it's more so the coordination of monetary and fiscal stimulus that we're about to get. I mean, Powell, they're going to cut rates. I don't know how many times they're going to cut rates before Powell is replaced by the new Fed chair. But if they don't cut if they don't cut before he leaves, whoever the administration brings in is going to be uber dovish and try to push for many more rate cuts thereafter. They're talking about fiscal stimulus. All these sovereign investments that we've seen from all over the globe are finally starting to make their way into the United States and actually deliver some kind of uplifted GDP. So as long as the one number that I'm looking at super closely is, as everyone is looking at super closely, is unemployment. And I mean, we saw it tick up to 4.6%. Had October jobs data was pretty bad yesterday, but November was a little bit better than expected. So we're still in this area of macro still looks pretty good, but it's definitely more fragile and increasingly more fragile than it's been over the last few quarters. And it's kind of what happens. Does unemployment fall off a cliff, and that becomes a bigger headwind and detriment to economic growth over the next year, and profit growth is hard to define for these sectors and themes that I focus on? Or do we get good enough employment data, resilient enough consumer spending, to a point where we do get all of these tailwinds, we do get this money pumping into the economy, we do get cheaper access to capital, and we still have a consumer that's pretty comfortable and spending at healthy levels? Which, I mean, throughout all the holiday data we saw from Adobe and Salesforce, all these companies, it wasn't a blowout. It wasn't like, oh my God, everything's amazing, everything is way better than expected, but it was in line to modestly better than expected. Which I think, I mean, amid the government shutdown and the lack of information we've had over the last few months, was an exhale for a lot of people. And I think there's going to be a lot of that exhaling over the next 12 months as we kind of flirt with unemployment levels that are still not, that are rising, but still in good shape. And then all the other tailwinds that I talked about start to kick in.
So you're kind of focused on employment numbers and then kind of the stimulus side of things, right? Foreign investments,
Yeah,
whatever kind of stimulant the Fed might pump in, interest rate cuts, and so on. I think it's interesting to note, right? Interest rates have obviously been front and center for quite a while, but the Fed's actually been cutting rates since about September of 24, right? So it's been this real dragged out slow rate cut, but we're down to 3.75 from about 5.25. Market keeps rolling. Do you have any thoughts on if they continue to stimulate the economy, we get some QE going, we get some foreign investments, rates are coming down, inflation cooking in the
yeah,
background?
yeah. So I think the backdrop for 2026 is pretty darn good because it really feels like they're gonna try as hard as they can to support the economy and support the stock market heading into midterms, and just make that be something that they can pound their chest about, like every incumbent wants to do for every single election. But I think as we get to the tail, as the sugar high kind of fades, um, where are we left? We are still left with questions about unemployment and what kind of impact does AI and automation have on future hiring needs. And we're seeing pretty high unemployment rates for recent college grads right now. And so it's 2026 optimism for me, and then it's 2026 optimism while looking over my shoulder probably the entire year and religiously tracking. Okay, we're getting all of this fun stuff, and like you said, what can end all of the fun if prices start rising faster than the Federal Reserve wants them to, and then the rate hike or the rate cut cycle ends, and we start hiking rates. And I mean, it's probably, but again, there's just so many confounding variables because they're going to bring in such an uber dove. I mean, the official that Trump brought in most recently, Moynihan, or I'm butchering his pronunciation, but or the pronunciation of his last name, but he wanted, I think his dot plot revealed like 6 cuts in 2026, and the mean is for 1 cut or something like that. So it just kind of tells you there are all these opinions in the Federal Reserve right now, but I mean, he still has to get other Fed officials on board to vote with him, but they are going to bring in more people who are going to try to drive down rates, and I think that is going to create some kind of sugar high for risk assets and valuations and profit growth. And I think the tail end of that, as we head into maybe 2027, is going to really be when we need to figure out, okay, did we just create, maybe not like a pandemic bubble where we're pumping trillions of dollars of stimulus into the economy, but did we create kind of like a pandemic bubble light where we were juicing an economy that maybe didn't need very much juicing, and now we have to really put on the brakes and create more pain and more of a reset and more normalization than we would have had to had we just kind of carried out, like you said, this very long, gradual, slow rate cut cycle instead of I want rates to be 1.5 points lower next year according to who we just brought in.
Yeah, yeah, it's interesting. I'm definitely curious to see what the market does as Powell heads out, right? Because Powell's kind of like everyone's grandpa that you're like, hey, I was on the podium at the Olympics, and he's like, well, you got a silver, so I mean, so it's less embarrassing, like he's Mister Perma, hawkish on rates and bearish on the economy, and so it'll be interesting to see whoever ends up coming in and how they treat that and how the market responds to that, and obviously how inflation responds to that, and I mean we're in this interesting spot where I just read yesterday, or maybe it was this morning, that Apollo. Did you see that report that Apollo posted about? They anticipate the next like 10 years to have zero return in the stock market for 10 years, which I'm like, that's a little aggressive. But so you have Apollo on this side. Obviously, you have the typical perma bears out there, the Michael Berries of the world, and these guys that are shorting everything. And then there's, I would say, an equal or maybe even a greater amount that is still bullish the stock market and looking for a decent gain for 2026. And I think you're right on the backdrop is interesting. The one thing that is probably safe to say about Trump, right, is that he will do anything possible to keep the market from falling apart, and whatever that takes, right? And the U.S. has a lot of resources to do those kinds of things. And I think this is where traders get it wrong a lot. You remember that interview with David Tepper in like 2009 where he said the Fed is backing the stock market, buy everything, right? And then we have this massive bull run from 2009 bottoms to forever, right? And so are we back in that space? Do you think the Fed and the government is backing the stock market enough, or the economy, that we could just see it go and go and go?
Yeah, I think our pain tolerance is a lot lower than it's ever been. I think our patience and willingness to watch stock markets fall 20-30% is a lot lower than it has been in the past. And I think the game is increasingly rigged, and increasingly rigged, increasingly supported by factors that you could maybe argue shouldn't be supporting it. And I think so we can decide. In my mind, is that it's not up to us to decide whether is that fair, is that a good thing, is that a bad thing, should they be doing this or not. I mean, we can have those opinions, but it's up to us to to turn $1 into as much money as we can in the stock market over a given period of time. So with that in mind, if they are going to just not openly but pretty openly just rig markets, and as soon as something breaks, we're just going to pump money in and make borrowing money a lot cheaper, and hand out stimulus checks and all these things that they've done in the last few years, it really does create an environment where the buy the dip mentality works, because they're again, they no one. I mean, you think back to Volcker and those times where just hiking rates to a zillion, and he doesn't care what stock markets are doing. And lost decade, who cares? I don't even know what that is. Who cares about stock markets? It's not Main Street. But right now, it feels like the stock market is very much so tied to the economy, at least in the eyes of our policymakers and decision makers. Which, I mean, pension funds and all those good things. Main Street it does have a vested interest in seeing stocks go up, even if they're not actively managing money like we are. But or I'm not managing money. You're managing money. I'm managing my own. But yeah, I don't know. It's a philosophical debate on whether we should be doing this, but the fact of the matter is we are doing it. So in my mind, take advantage by leading into risk assets and accepting a little bit more multiple expansion than you otherwise would, because there is this backstop and there is this gigantic, powerful supporter behind the scenes that is willing to pull the strings and be the puppet master whenever anyone decides we sort of kind of need them to be.
Yeah, yeah. It's interesting that I saw a report again. I think this was yesterday that we're back, and this happens very rarely, right? But we're back to a space where the average consumer now owns more of their net worth is in equities than in real estate. And these are like little short blips every couple of decades. Apparently, this happened in the 60s, happened again in the 90s, and we're back to this space where we own less real estate and we own more stock market. And the contrarian in me always thinks, where is everybody piling into, and what are the risks involved in that space? And so we have that kind of backdrop. But do you have any thoughts about? And I haven't even looked at this chart in the last couple of weeks, but with interest rates being as high as they've been, right? There was this massive influx of trillions of dollars into money market accounts, right? Risk free, 4.5%. Some were getting 5% for a while, and now that that's coming down, do we have a lot of money that's been on the sidelines that's coming back into the market?
Yeah, it goes back to, if I can't get as much yield in these super defensive corporate bonds, or in this money market fund, or somewhere else, uh, the competition, or I guess stock return competition versus a money market fund and versus everything else gets worse, and stocks get more compelling on an apples to apples basis, and multiples expand. So I really just think that it's just, everyone who's listening to this has heard the "don't fight the Fed" um, quote, and they're probably rolling their eyes at it. But don't fight the Fed. I mean, if they want to make us feel are motivated and inspired to buy stocks and make stocks go higher, they have so many tools at their disposal. I mean, we just saw them not start QE, because I know it's short dated bills and not bonds, but if they're purchasing T bills, that is, I think, step one of quantitative easing and pumping more liquidity into the banking system and eventually into the economy. And I just think but between that and the fact that they are talking about stimulus, and they are talking about more tax cuts, and they are talking about supporting the economy from that fiscal point of view, it's just, yeah, there's so much there's so much behind the scenes trying to push stocks higher. Yeah, I think I'll leave it there.
So I read recently that Buffett is parking a lot of money in yen denominated bills and bonds and so on. Um, the Japanese economy was on my radar pretty heavily, kind of beginning of this year, right? We saw I don't know if you were watching. We saw yields going crazy, right? They were like back to
Very fixed up.
1990s levels, just going nuts, right? And Japan has this major lack of GDP growth. Like for the past 35 years, nothing has happened GDP wise. It's been a flat line. And so Japan's got this infamous ultra high debt to GDP ratio and seemingly in a tough position. And I was finding myself worried about Japan and what could that mean for the US economy. You know, we love to borrow money from Japan for their no interest rates. We've got the carry trade and so on. And Japan's kind of back in the good graces. Have you been keeping an eye on? I mean, what do you think about U.S. dollar and Japanese economy concerns? Not in your purview. Where are you at on those?
Really, it's not in my wheel, not firmly in my wheelhouse. So I lean on people like you and other people for opinions on currency and FX and things like that. I really don't have personal or intelligent personal insight to share. I don't think it's something that I watch and not something that I can really intelligently comment on.
Do you look at stocks outside of the U.S.? Are you
Yes, yeah. Right
what are
now,
some countries you loving?
so I like my American brain likes economies and cultures and geopolitics that resemble the U.S. more closely than other parts of the globe. So just thinking uh, places like Korea, where it's pretty familiar in terms of their economy and very developed and demographic trends in terms of internet usage and population growth issues. Like they're dealing with a lot of the similar things than we are. Their population growth issue is worse than ours, but I mean they're paying people tens of thousands of dollars in tax credits to have kids right now because they need more people. Japan is in a similar spot, but for me, I'm so fixated on constant currency growth and foreign exchange neutral growth for these companies that I'm really just focused on if FX if they're going to get punished for like using a hypothetical example, like if Mercado Libre is getting punished because the Argentinian peso is going through tough times, or the Brazilian real is going through tougher times. To me, if a company is going to get punished for that for a few quarters because nominal growth is slower than currency neutral growth. I mean, currency neutral really tells you if we eliminate all these confounding variables and exogenous factors, what does their operational demand look like? And to me, that's what I'm very much so focused on because I mean, I would love to hold. It's the Buffett quote. My ideal holding period is a lifetime. I'm probably never ever going to get there for any company just because so many things change and evolve. But I'm very much so trying to hold companies for a couple of years, and as long as their execution is warranting my time and attention and support, and as long as their valuation isn't getting ridiculous, I will hold companies for a while. And to me, that's the kind of variable that if they're being overly rewarded because they're growing 80%, but currency neutral growth is 40%, then that's maybe a time to lighten up because that's not going to be a permanent tailwind for them, and vice versa. So to me, that's noise that creates volatility sometimes that I take advantage of, but it's not something where I'm basing an investment off of. Do I think the currency is going to move this way over the next 6 or 12 months? I mean, looking at just sticking with Latin America, like these juggernauts that I'm sure many of your listeners are familiar with, like Nubank and Mercado Libre, who've been around just for a very long time. And you look at profit growth charts and demand growth charts on a nominal basis, and it's there are blips and there are fits and starts, but it's up and to the right across all of these economic regimes, across fits of hyperinflation. So it is bad. So yeah, so macro to me is something to deeply respect, but it's not something to penalize a company for if they're temporarily being hurt because their economy is not performing well. If anything, if they're taking market share at a faster rate, if they're continuing to show signs of resilience, where on the back end of this, when things brighten, they're going to come out better than everyone else. Maybe it's time to look into maybe even accumulating. So that's kind of how I think about it.
Yeah, no, that's great. So on that note, I mean, are there some sectors? Are there some stocks that you think are being penalized right now that still have a decent backdrop?
Ooh, I think so. Super broad answer. So I think so within this AI laying infrastructure laying and if you sell GPUs or custom processors or memory or high bandwidth memory or anything that goes into data centers, you're a darling. Well, actually, not over the last few weeks, but until the last few weeks, They love you. You're going to beat and raise every single quarter. We're going to raise our estimates, but we're not going to raise them enough because you'll just beat again. And that has really been the theme over the last 2 years. And candidly, I don't own. I don't have a lot of exposure to AI infrastructure, so that's been a drag on the portfolio in 2025 for sure. But I think looking back on the cloud computing revolution and just kind of putting your historian hat on, it's always infrastructure that's laid first. It's always building the plumbing and the foundation that's going to eventually support a lot of data processing and a lot of app building and a lot of workload movement and a lot of integrations and APIs and now a lot of agents that can go across the digital ether and scrape this and that from all over the place to build workflows and to autonomously complete them. And I think all of the excitement and rage has been given to the infrastructure layer of this opportunity. And I think as we head into 2026 and 2027, the capex growth is eventually going to slow down. I don't know exactly when that's going to slow down, which is I think one of the reasons why it's so difficult to invest in AI infrastructure. But what I do know is once all this infrastructure is laid, and we get a better supply demand equilibrium, and maybe there's not so much incredible pricing power from such a massive mismatch or from NVIDIA having such a giant lead over everyone, because that's starting to dwindle a little bit when you look at Google and now Amazon signing deals with OpenAI and Anthropic. But when all of that happens, what happens next is that the second order effect is the app layer of this opportunity. The software builders, the software deliverers have access to way cheaper compute, so that they can build better products for the same budget that they had last year. They can build more complex workflows. They can drive more value. They can create more efficiencies. So I do think it is the app layer's turn to enjoy the party and to enjoy the billions and billions, if not, maybe it might be trillions at this point of, no, I don't think it is, but we're getting there, of data center infrastructure that's been laid over the last 2 years. And now we got to figure out what to do with it to actually drive return on investment. And that the software companies that are able to create that return on investment, you think about Palantir and their amazing explosion. It's because they've been able to create that value before any other software company. They've been able to create return on investment within software. So their software is better than everyone else's and creating more value. And they give you 15 case studies every single quarter about how their AI is driving value. But I think there are going to be a lot more companies like that are able to take all of this amazing potential and turn it into something that is palatable and digestible and super valuable from a consumer facing point of view, like a chat GPT, but just many different use cases and many different examples of like that, of not only driving cost efficiencies for these enterprise software firms, but creating new demand for new products and better products. So I think that is being discounted right now because everyone thinks ChatGPT is just going to create a perfectly vertically integrated enterprise software giant with every single pillar, every single security, observability, DevOps, everything lumped into one. And now you're hearing them say, well, Gemini is really good at models too, so maybe we should focus on our core and stop creating ads and ad-based products. So I think just there's going to be more focus from the model builders on making sure that they are winning in models and in the LLM arena, and there's going to be more understanding that the software titans that led over the last 10 years are not going anywhere, and this should be a net accelerant for their businesses. That's how I see things playing out. Just the major caveat is we've never had a Gen AI revolution or boom before, so I am speculating, and I could be wrong, and we'll just kind of have to see how it plays out.
Well, this sounds a little bit like I think you're on the same wavelength as Jeff Bezos and some of those out there that have said, "Hey, the dot-com craze created the internet. Not every company survived it, but it left us with the internet." And I think you're right on with, now we've got this craze creating all this AI and all these great tools that make things cheaper and more efficient and so on. And not all those companies are going to survive it, right? But the next wave of companies is where that growth is. So I'm with you on that. I think that's a good outlook. So to sum it up in a few words, AI bubble, or we're just taking a breath and it continues on.
Oh, in a few words, that's all I get.
As many words as you need.
Yes, it is an AI bubble. Yes, it is an AI infrastructure bubble. And no, I have absolutely no idea when it pops or how big it can inflate from here to in the future. So I think for me, the approach is don't touch, but sure as heck don't short. Like don't. I would like shorting Nvidia, right? Like Michael Burry, I know you're brilliant and you have a movie about you, and that's really cool. But I don't know if I'm shorting a company right now, and I've talked about this over the last few months. Just the temptation to short these quantum computing companies or the pure play neo clouds or things like that. That's where I'm gravitating towards before Nvidia or before AMD or Google or even Oracle and Broadcom, which I know have some. I know Oracle is so tied to OpenAI at this point, but still, OpenAI might succeed. Yeah, that's yeah.
No, I think that's solid. So we have seen a bit of a pullback on some of these big tech stocks, but certainly nothing drastic. I mean, Oracle has taken a little bit of a hit, but for the most part, they're all consolidating. They're all hanging in there. There's no major pullbacks. A space, and I don't know if you watch this at all or not, but a space that we have seen quite a bit of pullback, certainly in the last couple of months. Crypto related stocks. I'm not a big crypto guy myself, but I do love to watch Coinbase, and I like to keep an eye on MSTR and see what some of those guys are doing. And they're essentially getting murdered. And 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 I
I'm
think,
pulling up for my context. I'm just pulling up a stock chart.
yeah,
Sorry, I apologize for interrupting. Please go ahead.
no, I think Coinbase and an MSTR, you know, a lot of people have deep rooted beliefs in Bitcoin, and they say Bitcoin is whatever. And that's great. And some people say it's made up and it's not even real. And then there's a whole bunch of people in the middle, right? And we have these huge money managers, these BlackRocks and Fidelities and so on that have Bitcoin ETFs and Ethereum ETFs and so on. The way I'm kind of looking at cryptos at this point is a little bit more of a risk on versus risk off kind of. I would almost say that Bitcoin and those related companies are acting kind of like a little bit of a barometer for us of where the market really stands. You know, if you're throwing a bunch of money in a cryptocurrency that people are still trying to figure out how to even use, there's probably a lot of risk appetite, right? And if that's getting pulled back and we're seeing these stocks dipping 40, 50% on huge companies that, make, I mean, with the exception of MSTR, I don't know how that whole thing's going to end, but it probably won't be super great. but, uh, but I mean, do you look at that in any way, shape, form? How do you apply that to the market?
I'm definitely somewhere in the middle. I think figuring out how to get non-crypto nerds, and I'm a nerd, so I don't say nerd in a derogatory way, but just people passionate about, when I say nerd, I mean passionate. When people are super passionate about using this and making it part of their lives and going into the applications they need and running these transactions in ways that are less convenient than swiping your credit card or paying cash. Those people are, I think they are the small minority. But I think where the two places where I think crypto and blockchain are interesting is, I mean, we're again going back to the beginning part of our conversation, inflation. What happens when we pump all this money into the economy? And I think the fixed supply nature of Bitcoin is compelling from that standpoint. But you're still relying on greater fool theory to rely on all of these people deciding that the fixed supply of this is more compelling than the fixed supply of something else. I don't know, but I think where I get excited about crypto and blockchain is that it can drive cheaper, faster, more 24/7 available payment rails for companies that are providing existing payment products. So where I see it having a big impact in the next year or two is in a way that the consumer is not even going to see or even notice or understand is happening. I think I'm going to go on Nike.com and buy a new pair of running shoes and check, or Nike. I don't know if it's going to be Nike or I'm going to go to some merchant and buy a pair of shoes, and I'm going to pay with my credit card and check out, and that's going to be it. But behind the scenes, I really do think there's going to be blockchain rails facilitating this transaction again in a more cheaper and rapid way, and that's more compelling for all of these companies in the existing payment ecosystem to open up another portion of margin for them to each take a piece of. So better, faster payments is really where I see this. But I see it just making existing products more convenient, not creating just just completely proprietary ways that people are interacting with the financial system. And I know I'm in the minority, especially. I mean, I'm not 30 yet. I'm 28 years old. So most 28-year-olds, I'm sure, who are there's a lot of people my age who would strongly disagree with me and think I'm a doofus for not loving this asset class. But I don't hate the asset class. I just think it should be a way to enable existing business models to be better.
Yeah, agreed. Agreed. It has been interesting to watch, and I think in like 10 years, it'll be so interesting to look back on Bitcoin. What did it become? What did it do? But I think the technology around it is certainly more interesting. I had to send a wire transfer the other day, just normal bank wire transfer, and I'm like sweating over this like routing number and account number and making sure I get them right. And they make you fill out this whole, if it's wrong, your money's gone forever. And then you have this like Bitcoin address that's like 90 characters long, and I'm going, this is worse. Can you just scan my face and then know where it needs to go? But
Yeah.
yeah, I think there's some cool technology that's going to come out of all of it, but it's still
Yeah.
somewhat in its infancy.
I think we want Bitcoin to make that transaction better, but I don't want to see that 90 digit. I don't want to see any of that. Just behind the
It's
scenes.
it's
Yeah.
it's the worst. It's the worst.
That
Talk about
that was a
sweat.
better example than buying a pair of shoes from Nike. That transaction can be made much better with blockchain than going on Amazon and buying Nike shoes. So that was a better example.
I loved your example. It was great too.
Thank you.
So that's awesome stuff. So tell me if what's a better way to say this? Pressure is on, and you have to put a large amount of money somewhere now. Where's that space?
Ooh, pressure's on. Put a lot of money somewhere now. I think, man. So I'm like building a brand new portfolio, or I have an existing portfolio, and I have another position that I need to add to round it out. Sorry if that's too much detail.
It's but if you, let's say you have a clean slate
Okay,
and
I own
your
nothing.
broker platform crashed and
Okay,
you're in a pure cash position.
okay, got
What's the most interesting kind of, I would say, near term? I mean, just something we're coming into the end of the year.
yeah,
January's are kind of like everyone gets real testy around January. Is that the top of the market for the year? Is it, I mean,
yeah.
do you wait? Do you do nothing, or do you put it somewhere?
I'm not. I'm so the reason that I use such a long term investor mindset and had is because I'm so bad at trading shorter term price action. It's just not something that I have ever done well, or probably will ever do well, or have the temperament for. So I think if someone, this is going to be the most boring answer you've ever gotten on your podcast, so buckle up. But I think if someone's saying you have to invest, you own nothing and you have to invest in one thing for the next few months or year, I'm going with the S&P 500, just because I do think the diversification note is very important. I think I have the luxury of being able to spend my full time job researching companies, which to me, in my mind, just allows me to do the work that I need to do to build to in an informed way build my own ETF or my own batch of companies that I do think are higher quality than the average company in the S&P 500. But I don't think I would ever put 100% or close to 100% of my net worth in a single company. Right now, my largest position is 9.5% of holdings, and that's feeling like uncomfortably large for me. So it's that really 15 to 22 positions is where I generally play. And if I get this question from friends all the time, and they probably think I'm so annoying because it's like, what do I buy? But if you're asking me that question, you buy the S&P 500 and you close your eyes and you look up in 10 years and you'll be happy you did. But for in terms of single stocks, yeah, I just think owning more than one of them is so important that I don't think I'd own one of them. So I apologize for the lame answer, but that's it.
That's it's an interesting description because like you, I get this question a lot, and the answer is always, well, what's your time horizon? How's your risk tolerance? Blah blah blah. And and honestly, really, the answer is just get exposure to the whole market. I think it's funny how something like SPY, right? This ETF that just in the background is outperforming most hedge funds every year. It's outperforming every mutual fund. I mean, do mutual funds exist? Is that still a? I mean, are these guys still in business?
Yeah.
Like it's such a crazy thing that you have, a Nasdaq, some of these big Nasdaq ETFs and some of these big S&P ETFs, and they're just crushing it. I interviewed on one of my past podcasts. The entire strategy of this fund manager was just buying options on the S&P on SPY. That was their entire strategy, and they're killing it. And they're actually outperforming the SPY, which is
Good for
wild.
them.
But it's an interesting thing that you can kind of beat your brains out, and then just SPY just rolls along.
Yeah. I'm spending my entire professional career trying to outperform a benchmark by a couple points, like on an annualized basis. That's what I'm doing. So does that sound exciting to you? Like, do you want to learn about companies? If so, then yeah, great. But if not, if like I have a full-time job and I have kids and I have a life, I'm just and buy it. Yeah. From someone who sells stock research for a living, buy the S&P 500 if you don't feel like spending a lot of time, for sure.
Well, and in your defense, as a researcher and as somebody that sells research, it's an interesting chart. Everybody should go look at the S&P 500 versus like Berkshire Hathaway stock, right? And I think since inception for Buffett's company versus the S&P 500 over that same period of time, SP obviously goes back a lot further, but since like I think it was like 1960s, right? And Berkshire Hathaway has returned like 45,000% over that period of time, and the S&P was like great still. I think it's 5 or 8,000%, right? And so there is a super important space for this research, right? And for a little tiny bit more concentration. The S&P is
Yeah.
great. You get all this diversification or diversification, whichever you want to call it, and but to really dive in on these sectors and do the research that you're doing and try to hone in a little bit more and get a little less broad. Um, if you can do it right, the long term is very significantly
Yeah.
better potentially.
And it's definitely a labor of love. I mean, I'm sure you're passionate about stock markets and financial markets. I'm super passionate about financial markets. It's building a portfolio to me is like building a puzzle, and it's super fun and super stimulating and super rewarding. If I mean, I've only been tracking a portfolio religiously for 3 years, so I really can't start pounding my chest about doing well versus benchmark. I don't think before several more years pass and we go through cycles and all that good stuff. But it's super stimulating and gratifying and rewarding, if again, if you have a lot of time and a lot of patience, not even a lot of, and I wouldn't even say if you have a lot of, I mean, I have a master's in finance degree. I think I could have gotten what I got out of that program for stock investing in a tiny fraction of the time I spent in that program. Just teach me how to read financial statements, teach me what all the lingo means, and set me free and let me learn through failure for a couple of years is basically what it was at the beginning. Yeah, I just think it is super rewarding. You are right, and I do believe in stock picking. But I think that plan B for people who want to climb their own corporate ladder and who want to go
Yeah.
to the, yeah, like that the plan B is so, like, to your point, it's so awesome that we have such a great plan B, I think, is the point.
It's certainly an amazing plan B. Plan A, it's a lot of work. You're seeing it, you're doing it every day. It's a lot of work, but there's a big potential payoff in the end. But plan
Yeah.
B, get a couple good ETFs and let it roll and go hang out
Yeah.
on the beach. That's okay too.
Yeah,
So
sure is. Sure is.
oh, that's awesome. Well, that's great stuff. Tell people where they can find out more about what you're doing and follow your journey a bit more.
Yeah, all my writing is on stockmarketnerd.com. There's a bunch of free content on there, so you don't have to swipe your credit card to start reading. Yeah, it's just a lot of coverage. You'll see when I say labor of love, you'll see that very apparently shining through the writing. But ton of earnings reviews, weekly coverage of a pretty large network of companies, real time coverage of my portfolio anytime anything changes. There's a Discord room where there's several hundred passionate investors who just exchange ideas in a very friendly way, which as a Michigander from the Midwest, I definitely appreciate the friendliness of that group. But yeah, I think it's a great subscription. And if you do too, then check it out.
Awesome, and we'll definitely include all those links, your X profile, your website, and everything in the show notes on this one,
Thank
so
you.
everyone can check it out and see what you're up to. But Brad, it was awesome. I think you're doing some good work, man, and it's a dirty job, and so got to get out there and get buried in the research. But there's some good stuff to be found there. So thanks for sharing your thoughts with us, and we'll stay in touch and hopefully have you back on the show again soon.
Yes, sir. Love to. Thank you for having me.
Thank you.